And now on to our broker's call for the day, handpicked by Sulhi Azman. We have DiGi and analysts have actually met the company yesterday for an update. So Sulhi, what's the takeaway?
That's right, guys. You know, this stock here is actually called DiGi.com Berhad, which has a 29% revenue market share. Now, this stock is liked by myself because I use DiGi as well as our colleague Nadia. Yes, yesterday was an analyst briefing, and three takeaways from the analyst briefing. Number one, CIMB research reckons that competition is going to remain intense in the third quarter because the TM and P1, they recently formed alliances to venture into the mobile segment. You know, that could even make margins a bit more squeezed there. Number two, the steep depreciation in the ringgit that will put margins pressure into the international traffic settlement, which is priced in US dollars. And number three, CIMB research says that DiGi will continue to roll out the LTE network with a target coverage by 47% or 45% by the year end, and also up to 70% by 2017. Now, the stock, what did the CIMB reckons? They reckon that the stock is upgraded from reduced to hold with a higher target price from 5 ringgit to 5 ringgit 15 cent. And why is that so? It's because the share price has fallen 14% year to date, and valuations now seems to be a bit more fairer, I think. I mean, the challenging market has surely put valuations in a more sensible. And this will, CIMB said, will be supported by decent yield of around 5% in the midterm. Now, I don't know about you guys, but do you guys like the telco stock? Would you buy into DiGi?
I don't know. The key is competition right here, right? So it's so intense between all these
operationally, it's a tough place to be in, right? Especially with the P1 coming in, and there's all that competition as well. They're the smallest player, but the thing is, the only reason why it's been raised from a reduced to a hold is because the share price has fallen for 14% year to date. So what do? You buy it now, you see some kind of recovery in the share price, and then you hold it up for your 5% dividend yield. Because don't forget, this is one of the safest stocks in the country, even though it's the number 3 player by market share.
I think telcos in general are actually quite resilient.
Yeah, and it's also 49% owned by Telenor of Norway. And in the time you've got a foreign-owned shareholder, they want to suck back as much dividends as they can, because that's what it's all about, right, from foreign subsidiaries.
So by virtue of being a shareholder, you're safe in terms of dividends because...
it's like having FD, you know what I mean?
Yeah, I think the dividend has also been very decent as well. I mean, coming back to Chuang's point earlier, competition is going to remain intense because you have all MVNOs around, you have Altel, you have other players as well. These would really erode the margins. And as you know, Maxis and also other players, Axiata has continued to be aggressive in their marketing, for instance. And it's
also highly intensive in their capex as well.
Exactly,
their capex, but then good thing about their capex is that their capex are denominated in ringgit, so they don't have to actually restructure their capex when it comes to the US dollars, unlike Axiata and also Maxis, which is highly exposed to the volatile USD to ringgit movement.